right, the recorder's going, and I wanted to have the recorder on just in case anybody wanted to review. But Murtaza put out an analysis that he did and an actual trade that he put on, and we were going to go through this and see A, if he's right, and B, if we agree with it. All right, so he's looking at IYT, which is the transport ETF. IYT. Here's the daily chart on it. Okay, we've seen that it is down just about 1% today, which isn't a bad thing. It traded up through about the endish of February, and then it came back down, found the bottom of the channel here, right above the 50-day moving average on the 8th, and then has moved up. We see that it opened up above the POC, and then it's we said that it's down about 1% here. So, I would be a little bit leery if we take out. You can see where these congestion lows are. If we close below that, I think that you can go and visit the 50-day, at the very least the 50-day. So be careful of that. For me, I think this is just kind of a range-bound trade. But if you're bullish for whatever reason, if it fits you, there's no reason why we can't look at it. Okay, so we've come to, or at least Murtaza's come to the conclusion that he's bullish. Okay, so now we have to figure out, okay, great, I'm bullish, what do we do? First thing that should jump into your head, with a low, the transports are going to have a low implied volatility. Probably don't want to be selling a whole lot of premium here. So a credit spread, you're probably not going to be able to work out very well. But a debit spread, you would. So let's bring the trading tool in. And it is trading 126.23. And he went out to May 17th. So that's 5/17. And the implied vol for May 17 at the money is 15.9. Hopefully that's close to what you had. Let me make sure that you had 14.3. I have 15.9. But at any rate, that should be, in my opinion, you should be targeting the 190s, the high 196 or 97s to 198s. You're probably only going to have $5 or $10 wide strikes here. Nope, you have $1 wide strikes here. So and you put on the 192.95 call spread, which is perfectly fine. I think that you could have targeted 196 or 197 easily, but if this fits you, so 192, 195 call spread, and put it on for, I think you said $1. Hang on, let me read here. So I just wanted to make sure that use the tool proper based on implied volatility. Oh, because I have, oops. I was like, that doesn't make any sense. That's trading so cheap. 192, 195, because I had the wrong expiration up. This is trading 85 cents. And I think you probably put this on, that you were talking about this when we were trading probably a little higher, so trading it for $1. So if you put it on for $1, we can look at what the reward to risk is. 192, 195 call spread. That is 195 or higher, and we paid $1 for it. So we can make $3 on our spread. We have to pay $1 no matter what to watch this play itself out, so we can net 2. So you're getting 2 to 1. And so that's exactly what you said. You said, and providing a reward of $2 and a risk to reward of 2 to 1 based on how you did everything right. Yeah, so that makes sense. That you bought it probably 70 cents higher, so somewhere around there, 65 cents higher, which would make sense that you bought it for $1. Yeah, it's under a little bit of water, but you have until May. And like I said, you're getting 2 to 1, which isn't great reward to risk, but you're targeting well below what even the 59% confidence interval is, which is 196.77. I think you easily could have gone to 197, but you're still getting 2 to 1. A little bit thin on the reward to risk for me, but that's because I think that you're targeting a little bit lower than maybe I would have. But perfectly valid. I think your thought process was perfectly good. Good work. That makes me feel good. It's getting through An epiphany. Okay, so I did record this. Anybody have any questions about any of it before we turn the recorder off and I render the video and get it out to you guys? Okay, thank you, Murtaz. Thank you for sharing. These are the type of things that I love to see in the room, because that means that we're learning and thinking, and if part of our thought process was wrong, or at least not, then we can talk about it. So I don't see anything wrong with what you did at all. The only thing that I would have done maybe a little bit differently, well, one, I guess I kind of see the trade or the trend as pretty neutral here. Not bullish, not bearish, but if you're bullish, that's perfectly fine. I think that maybe I would have targeted a little bit higher, just to strike higher. You're not way off, but that would have given you a little bit more reward to risk, right? Because if we did the 93.96 even, well, the 93.96, that's going to trade, and even if we were trading a little bit higher, that would have probably traded about 90 cents instead of $1. So if we trade that for 90 cents, if we did the 193, 196, and that's going to max itself out at 196 or higher, and I think I could have got that for 90 cents. 2.33 to 1. Just a little bit different, a little bit cheaper, saving yourself a dime here, a dime there, can pay off over, but really we're splitting hairs. I think you did a good job.